Justin Sun recently staked $154 million worth of Ethereum on LIDO. That's 45,000 ETH flowing into the protocol, while LIDO sits around 70 cents, testing a support zone that's held since 2022. When the founder of Tron makes a 9-figure move into liquid staking infrastructure and VanEck files for the first staked ETH ETF in US history, you pay attention, because either this is accumulation at a generational level, or we're about to see that ascending channel support finally break. I'm going to show you exactly what the chart says, what the fundamentals mean, and the 5 price targets I'm watching with my own capital at risk. LIDO is trading around 70 cents, down from December 2024 highs near $2.40. Over the past 2 weeks, we've seen consolidation right at the lower boundary of that multi-year ascending channel, the same structure that's defined this entire bear-to-bull transition since the 2022 bottom. The $26 billion question is whether this support holds or if we get a deeper retest toward 45 cents. Market sentiment on liquid staking has shifted dramatically. The SEC's evolved stance, institutional capital flowing in, and Ethereum's dominance in DeFi are creating a setup that looks nothing like the regulatory fear of 2023. But sentiment doesn't move price. Structure and catalysts do. And right now, both are converging at this exact level. Let me break down why the fundamentals matter first, then we'll go deep into what the weekly chart is actually telling us. LIDO isn't just maintaining dominance, it's expanding it, while regulators finally get out of the way. Start with the VanEck filing. This is the first LIDO-staked Ethereum ETF proposal in US markets, targeting institutional investors who want compliant, tax-efficient, staked Ethereum exposure. The SEC clarified in August that staking receipt tokens aren't securities, and VanEck is capitalizing on that clarity. If approved, this could funnel billions in traditional finance capital directly into LIDO's ecosystem. Then you've got the Chainlink CCIP integration. LIDO is adopting CCIP as the official cross-chain infrastructure for wrapped staked Ethereum across all supported networks. This isn't a minor technical upgrade, it's a strategic commitment to decentralized security and interoperability, as wrapped staked Ethereum becomes the collateral standard across Layer 2s and alternative Layer 1s. Chainlink's battle-tested infrastructure means it can scale without introducing centralized bridge risks. Now layer in the product innovation. LIDO just launched Strategy, which is essentially a set-it-and-forget-it DeFi yield optimizer built on Melo protocol. You deposit staked Ethereum once, and it programmatically allocates across Aave, Athena, and Uniswap, automatically rebalancing to optimize returns while earning Melo points. For anyone who's managed DeFi positions manually, you know the time sink. This productizes that entire workflow. If you want the complete breakdown of managing multi-protocol strategies like this, I've compiled all the tactics in my DeFi guide, available in the pinned comment for just $4.99. It walks through platform integrations, risk management, and the exact workflows I use. The Ethereum Protocol Advocacy Alliance announcement shows LIDO's positioning beyond just technical dominance. They're a founding member of an organization explicitly designed to counter centralized influence over crypto policy. That's not virtue signaling. That's protecting the regulatory moat that allows liquid staking to exist without being classified as a security. And then there's the elephant in the room, Justin Sun's $154 million stake. When a founder with that capital base chooses LIDO over running his own validators or using competitors, that's a signal about where smart money sees infrastructure value. Combine that with Leon Wademan's data showing Ethereum now holds over $100 billion in total value locked, with LIDO as the anchor tenant at $29.6 billion, and you're looking at a protocol that's not just surviving, it's cementing network effects. The DAO even proposed an automated LIDO buyback mechanism, deploying protocol-owned liquidity. That's a structural bid on the governance token funded by the protocol's own cash flow. Fundamentally, this is a protocol generating over $900 million in annualized fees while trading at a $630 million market cap. The revenue is there. The question is whether the token price reflects it. So let's talk about what matters, the chart. LIDO has respected an ascending channel since the 2022 lows. That's the pink dashed structure you're seeing, currently providing support right around 60 to 70 cents. Inside that, we've got a descending channel since 2023, marked by those yellow dashed lines, creating a compression pattern. Price is now sitting at the intersection of ascending channel support and descending channel compression. That's your inflection point. I've anchored Fibonacci retracements from the $2.40 December high down to the 62-cent lows we saw in April and June. The key levels are the 236 fib at $1, which was the last major rejection zone, and the 0.5 fib at $1.50, which also aligns perfectly with descending channel resistance. Notice that August rejection right at 150. That wasn't random. That's where structure said no. Volume profile shows the point of control at $2.30. That's where the most volume traded historically, and it tends to act like a magnet once price starts trending. Right now, we're far below it, which means there's a lot of air to move through if bulls take control. Heikin-Ashi RSI is oversold and still pointing down. For me, that's not bearish, it's opportunity. When you're at structural support with oversold momentum, you're either setting up for a bounce or a final capitulation. My strategy accounts for both. Here's my position. I'm dollar cost averaging between 60 and 90 cents. This is my load zone. My short-term stop loss is 55 cents on a weekly close basis. That invalidates the ascending channel structure, and I'm out of my trading position. For my long-term bag, I'm holding through any dip because I believe this is still accumulation territory for the next cycle. If we do break below, I would look to reaccumulate around 45 cents. That's where the descending channel support sits. My take profit targets are $1.20, $1.50, $2.40, $3.50, and $5.30. The first three are where I'm trimming hardest, because that's where the descending channel, Fibonacci confluence, and volume profile resistance all stack up. I'm using a trailing stop strategy. Once I hit target 1, stop moves to entry. Hit target 2, stop moves to target 1. That locks in profit while letting runners work. Best case, we hold this ascending channel support, break through the descending channel resistance at 120, and retest that 150 level where we got rejected in August. That sets up a run toward the old highs. Worst case, we lose 60 cents on a weekly close, retest 45 cents, and I'm looking for confirmation of a higher low before reloading. Timeline-wise, short-term traders need that 60-cent hold. Long-term holders, this 70-cent range could look generous if those ETF approvals and institutional flows materialize over the next 6 to 12 months. What would change my thesis? Weekly close below 50 cents without a quick reclaim. That would suggest we need to reset lower before the next leg. Bottom line, LIDO is holding $26 billion in TVL, generating $900 million in annualized fees, with institutional products, cross-chain infrastructure, and DeFi integrations all accelerating, while the token trades at multi-year support. Whether this is your entry or you're waiting for confirmation, the setup is clear. If this resonates, hit that like button, subscribe, and turn on notifications. Join my free Telegram group for faster daily updates. Links in the pinned comment. Thanks for watching, never financial advice, and I'll see you in the next one.